Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So what I want to do today is I want to add a high growth company to this portfolio. I'm going to compare two companies and one of them will be in the portfolio by the time we finish this video, inshallah. I'll explain why I've decided to do this and why I've actually made the decision to add a high growth company that doesn't pay any dividends, considering I've already said I want to keep this portfolio just dividend paying companies. Now, if you haven't liked the video already, please do so, because really genuinely that's all I ask and it really genuinely helps. Also, if you can join us on the Discord and the Patreon account, go ahead and do that. You get access to all of these things, inshallah. And I'm now making some changes to the trackers, inshallah. I will be sharing that with you guys. If you're new to investing and you want to basically look at the Sharia compliant investing ebook, have a look at that. I will be updating, inshallah, in the coming months. So there's a lot of little things that you can get access to, and obviously get access to the Discord and ask questions and so on. I will be answering a lot of your Discord questions in the next couple of days, this weekend, inshallah, as well as basically answering your questions on the videos and so on. So going forward, that's the plan. So let me give you a very good news from Trading 212. Now you're going to have to go away and verify this, but there is a investor section on the Trading 212 app. Okay, so you got the investor section and you've got the CFD, which we don't touch, and we've got the ISA account. The investor section, what they used to do before was to, if you own shares, they loan out your shares without your permission, and they basically gain some sort of interest on that. And for that reason, the scholars have said that's haram. They shouldn't be doing that. So for that reason, I've never actually used it. I've actually used to use it before. Then when I found out, as you can see, there's like a little tiny money there. If you look at my older videos, you'll see I think I used it a few times here and there. So then I found out it wasn't Sharia compliant, so I left it there. Now what they've done is, if you go to this thing, this is what mine looks like. As you can see, there's nothing there. There's a section here where it says earn interest on your shares. If you click that and go through this, then that's when they will loan out your shares, and that means they will give you some sort of interest. Okay, if you don't opt in, then you don't have to worry about it. So for that reason, I think we're gonna have to do a little bit more research as a community. Don't rely on just what I'm giving you now. But if they are no longer giving out our shares without our permission, okay, then, and we don't opt in, then obviously they're not going to use our shares and loan them out. For that reason, it should be Sharia compliant. Okay, so that's just to let you guys know, so you have that information, inshallah, going forward. But yeah, so that's one thing I wanted to share with you guys. But make sure you also do your own research. Please go to their website, read about the article. There was an article that they sent, I think. So do all of those things before you take this as new information. Now, final thing I want to talk about very quickly before we look at the two videos, stocks, is why have I now decided to add a non-dividend paying company here. The reason is very simple. This is an ISA account. I don't pay any taxes. If I buy a high growth company, like I used to have Tesla and so on, made quite good money on that. When you make a sell and you make, I don't know, £700 or whatever it was, for these shares, then that money is yours and you're not going to get taxed, right? But if I add that into maybe the investor account or any other account, right, that's not basically an ISA account, then you're going to pay a lot of money. High growth companies do not pay dividends, so you're going to have to sell some things to realize some of the gains at some point. And when you do, obviously the government and the tax man will come for their money. And for that reason, I've now decided I was being very silly and getting rid of my non-dividend paying companies in this portfolio and never buying them again anywhere else. The family portfolio is slightly different. That's for the family. But for this account, I want to make sure that I have high growth companies as well as the dividend. So as we go along in the next few months and years, inshallah, you will see both non-dividend paying companies that are high growth as well as these dividend paying companies. I'm also looking at the portfolio and looking at where the slow growers are right now, going forward, and the future and so on, and maybe reducing the slow growers to higher growth, basically high growth, companies that are growing slightly higher than maybe double digits and so on. So inshallah, there's a lot of things that I want to share with you guys. As always, I'm going to be transparent, be honest, and tell you exactly what I'm doing, when I'm doing it, and so on. all I ask is you like the video, subscribe to the channel, ask us any questions, join us on the Discord, Patreon, okay, those that £4 whatever, get access to those things. Let us know if you have any questions. That would be really, really nice. Thank you. Now let's have a look at the two companies that I'm thinking about adding to the portfolio. So the first one is Fortinet, then the other one I'll show you in a second. This company is a cybersecurity company. As you'll know, the world has changed a lot. There's a lot of things going on right now with Russia, with North Korea, with the US and everyone else, okay, with basically Ukraine and everywhere else. And cybersecurity is becoming this new thing where basically people are literally the Chinese or whatever attacking the US basically government because of trying to hack into their systems and so on. Now the US is doing everything they can to make sure they protect their systems, and there are a couple of companies that actually benefit from this sort of thing. So you've got this company, you got CrowdStrike, you got and you also got Palo Alto Networks. These three companies are the forefront when it comes to security. What I want to do is, and I can see the market, this market in terms of cybersecurity growing for the future, for the foreseeable future. Now, software companies, especially software as a service companies, I do like them. And as you know me, I've always talked about that. And right now, the only company that I do have, so that's like a SaaS model, is actually Microsoft. So I'm looking for companies that either, so the hardware, so some of these companies, by the way, they also do the hardware as well as the software side of things, okay? So if the company does both of them, perfect. If they just focus on the software, I don't mind, whatever it is, I'm looking at this field and thinking, going forward, this could potentially, again, I'm just speculating, I'm just giving you my opinion, okay? This could, basically, the market could grow really fast in the next few years. It could slow down, it could go fast, but I'm going to take a chance. And I'm going to add one of these companies I'm going to talk about today by the end of this video, inshallah. So the company is Fortinet. Basically, right now, current share price is $60 per share. It has come down quite a bit in the last few weeks. It has EPS. It's actually positive EPS of $1.33. So they are actually making money. They're not really a losing company. Market cap is $44 billion, and it has a wide economic moat, and beta is actually not bad for a company that is basically growing really fast. Now, current PE is about 45. The forward PE is 37. Okay, so based on their growth, obviously they expect the forward PE is about 37. Now the market, the sector right now is about 35, and the S&P 500 is about 23, give or take. The 5-year average for this company is 56. So based on this, it looks like it's actually trading slightly cheaper than it has been in the last 5 years. The price to free cash flow here, we're looking about 24, which is really low as well. The PEG ratio, okay, which is something else that we also use, is also just normally we're looking for a PEG ratio between 1 and 1.5. okay, 2 is okay. It's not too expensive, I would say, but it's slightly higher than what we normally look for. Free cash flow right now is $1.82 billion, which is nice, especially in this type of environment, basically where interest rates are very high. The company that has a free cash flow can use that to kind of build, obviously reinvest in the business and so on. The danger is when companies do not have an excellent free cash flow here, what happens is they need, in order to grow the business, they have to go to the bank and borrow money. And right now, interest rates in the US are like 5% or whatever it is. So to basically keep that going and pay that 5% is a lot of money, especially for the company. So they will be literally, that's not a good for the company. So I like the fact that they've got excellent free cash flow here. Free cash flow margin of 32%. We're normally looking about 3%. That's actually way higher than what we want. And free cash flow yield of 4.4%, and 3% is what we said we normally look for. Profit margin is 17%, operating margins basically is 19%, and return on equity is basically negative at the moment, okay? But the last 10 years, they've actually returned almost to 30% to investors, and return on invested capital is 132. So in terms of this side of things, in terms of return on invested capital is actually quite good. Revenue, in terms of compounding annual growth rate in the last 5 years, we're looking about 34%, and current ratio is above 1, which means the company has enough money for the next 12 months to pay off any debt that the company has. So like the basic current debt, that current liabilities, it can easily cover. Okay, the current assets will cover the current liabilities basically. Okay, then what we're looking at is, this is the reason why are we talking about this company. So next year, the company is expected to grow their earnings about 19%, which is really fast. Then the 5 years, then 5 years after that, so every single year after that, for the next 5 years, they're expecting about 19% as well, which is very, very good. Now, fair value according to Simply Wall Street is $84 per share. That means the company is undervalued at the moment about 30%. Now, Morningstar is slightly different. They're saying it's about 11% discounted right now, and their price is $68 per share. Okay. Now, according to TipRank, for the next 12 months, only for the 12 months, by the way, this is only for the next 12 months. They're saying about $78 is where the price is, should be. Okay, and basically they're saying it's about 33% upside from now, from where it is. And according to them, it's a strong buy. Seek and Alpha is a slightly different, but well, more or less the same. These two normally use, I think, the same analyst, so for that reason they're very, very similar, but they have a buy rating for this stock. In terms of Sharia compliance side of things, there's actually no issues with this company. I like the fact that interest-bearing debt is very, very low, and the security side of it. And they have been buying their own shares, which is really good. So not only do they actually have some cash in the bank, they're using some of that cash to buy back when the shares, hopefully when the shares are cheap, not when they're expensive. So that's something that we really need to see. Now, if we look at the earnings going forward, and go to Seek and Alpha, you can see the earnings in 2020 EPS. This is okay. Earnings per share is expected to grow almost to 27% this year. Then next year about 16%, then 23%. So if you just focus on the first three, we've got 32 analysts, 34 analysts, and then 13 analysts. So if you just focus on the first three, it looks really good. That's excellent double digits there. Same goes more or less for the earnings, for the revenue. Again, the first three, 22%, 18%, and 18% again, from 5 billion to 7.5 billion, or 5.4 to 7.58 billion dollars. Okay, and from there, if you carry on all the way to 2022, you can see we're looking at about 22 billion dollars. But there's a couple of only people there. Only Allah knows what happens by the time we get 2032, but that is still basically where the company is heading. That's where they're saying this company is heading. So that's the first company. The second one, no surprise, is Palo Alto Networks. Again, it's a similar sort of a company. They do the bit of the software, bit of hardware side of things. Currently trading $219 per share, and EPS just positive of $0.64. Okay. Or 64 pence if you like. Market cap is based on 64 cents. Market cap, we're looking at about $66.8 billion. The other one was about what, 40 something. So that is slightly basically smaller. So this one is slightly bigger in terms of market cap. It has a wide economic mode and is basically beta of 1.2, which is fine. PE right now we're looking at about 344. This company didn't have a PE up to very recently because they didn't have the earnings part. The E part wasn't really there. Okay, so basically the earnings was not there. So 344 right now. The forward is only 55, and 5-year average for this company is 59. Again, like I said earlier, this you have to think about it because this is still a growing company, and they've only now started basically becoming a positive in terms of earning side of things. Okay, price to free cash flow for the basically right now is about 26, and PEG ratio about 1.34. So the other one seems cheaper when you look at this basically metrics. Okay, and when you compare it with the sector and the S&P 500, free cash flow 2.74. So it's got more cash. Free cash flow margin of 32, and free cash flow yield of basically 4.10, which is basically, I think, is slightly higher than what we've seen here. Okay, so this one is actually higher, sorry. So this is the same, that's slightly higher. Now, profit margin 3%, operating margin 2%, sorry, return on invested capital about 32, and last 10 years they've returned about, this is interesting actually. Let me just double check why these two digits. Hold on a second. Have I made a mistake somewhere? Because that and that, it looks the same to me. Actually, it's very similar, but not the same. Let me just double check. Let's go to this place here, and we're looking at for the last 10 years for this company. Oh, last 10 years is 30%. Okay, so last 10 years, total return in the last 10 years, we're looking about 30%. So not what I've said here. Okay. Which is basically more or less exactly that. So if you round it up, I guess. But yeah, so it's more or less the same. And then when you look at the revenue compound annual growth is 25%, and current ratio is just below 1. So this means they might not be able to cover their current liabilities, but they do have some free cash, and they've got more cash than actually Fortinet. Okay. Now, in terms of going forward, this is where this company shines in terms of growth going forward. The other one, remember, was 19 and 19. This one is about 17 for this year, and then 33.88%. Let's call it 34% going forward every single year for the foreseeable future, for the next 5 years at least. Now, according to Simply Wall Street, it's about 30% discounted right now. Morningstar is only 6%. Price, TipRank is actually saying is 23% an upside, and their price is about 262. It's a strong buy from them. Seeking Alpha, more or less 20% upside, and is a buy right now as well. So they are both undervalued according to these companies. Remember, these two basically use intrinsic values. These two basically are using the analytics, but basically expectations or estimates, if you like. So you have to be careful. Now, in terms of Sharia compliance side of it, there's no issues with that. And they have not been buying their own shares. They have been increasing their shares. Okay, so they are diluting the shares. But because now they're positive, hopefully, and they've got a bit more cash, next few years we might see this decline. Okay, now let me quickly show you the EPS and the estimates for the earnings estimates, sorry. And EPS, we're expecting about 70% this year, okay, according to Seeking Alpha. And then June 2024, they're expecting about 16%, then 18%, let's call it 19%. Okay, so the first three, again, we focus on the first three. And then if you look at their revenue growth, 25%, 21%, 19%, and then so on. So the companies are very similar in terms of this. I think the growth side of it, this one is slightly a bit more than the other. And if we look at the companies, this company works with, there's so many. The list there, I've just looked at their list of customers, okay, and it's so many. This is Palo Alto Networks. So there's so many companies, some of which I've never heard of. Some of them obviously are like movie cinemas in the Middle East and so on. There's so many different companies. Salesforce is one of the companies that they work with. So there are even Westfield in the UK and obviously other countries as well. So you've got a lot of companies, they've got a lot of basically customers that they work with, and some of them are some of the biggest companies that are out there. So they are very much well trusted, basically to protect other companies like Salesforce and so on. Now, same goes for Fortinet. They also have loads of different customers. Okay, Siemens, for example, is one of them, Alaska Airlines, and there are loads of other companies, some which I've never heard of, some I've heard. Now, so I now have a decision to make. So I really like both companies. I like their product. Okay. So my decision is to add Palo Alto Networks to this portfolio for now. Now, what I mean by that's for obviously I'm going to add this company for the long run. And maybe Fortinet will probably be added either to this portfolio in the long run or the family portfolio. I really like both companies. I like their product. I've actually gone through extra information, but done a little bit more research as you would expect. And I looked at the customer service side of things. So I looked at what their customers are saying, both of them. And Palo Alto right now seems a little bit more ahead, but they are very, very touch and go, the difference between the two. So for now, I'm going to buy a couple of shares of Palo Alto Networks, and that's what I'm going to do. But inshallah, in the long run, you might also see following Fortinet basically in this portfolio going forward. So I'm going to add 5 shares. That's £8,580. I'm going to send that to the market. Today is not a great day to be honest, to add this company, because it is the only company especially in the tech side of things, that's up today. It's up 2%, almost to 2.4. But again, like I've always said to you guys, it's not about what's happening on that day, it's what's going to happen in the long run. So I'm going to add anyway those 5 shares. I'm going to send it to the market, inshallah, and then we'll see what happens. Okay. So Palo Alto Network should now be, there we go. I've got 4.8 shares. Okay, I've wanted to buy 5. I don't know what happened there, but 4.8 shares of that company should be in my portfolio, inshallah, going forward. Sometimes it splits the buy, so maybe that's exactly what's happened. But there you have it. So I'm going to continue, inshallah. I'll let you know if I basically what my decisions are going forward, if if I want to add the other one or not. But as always, I'm going to be honest and transparent, just like I have been today, and so on. Again, please, if you're interested in any of these companies that I own in the portfolio, always do your own research. Okay, my reasons for these companies are slightly different to yours. Please don't lose your own money. Make sure you're buying companies that you've done research on and stuff. Have a wonderful day. Assalamu Alaikum.